Hello, happy Monday. Welcome to another Money Monday with Purse Strings. Today, we're going to be talking about divorce and home ownership and really understanding some of these nuances that are so important to know about when going through the divorce process or understanding what you're going to do with your home. And so, for those who are new here, Purse Strings is all about providing tips, tricks, pieces of advice on how to be financially fearless. And then, let's say you're going through a divorce, buying or selling a home, need a will and trust, whatever it may be, we have top tier financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Jamie is one of them. So we're so excited to have her on today to share her expertise. But before we dive into that, Jamie, could you give us a little intro of who you are and what you do?
Absolutely. So I'm Jamie Minster, and I am a loan officer. I've also been a CDFA, or a divorce financial analyst, since 2014. And I also have a background as a financial advisor. So kind of all these things come together to make up how I serve clients that are particularly going through a divorce, but anyone who's buying a home, certainly.
Awesome. Yeah, we're excited to have you on to kind of share your expertise with this divorce specialty and really what you need to know about buying or selling your home at that time. And so if anyone's watching live and has questions during the conversation, please throw them in the chat and we'll get to those. But just to kind of start, most people always say, well, I'm just going to stay in the home and just like to do that from the get-go. And so when people say that to you, what are some of the questions that come up that you kind of prompt to someone why should I just stay in the home?
Sure. So there's a number of questions here. Number one is, how is the mortgage currently set up? Are both of you on the mortgage? Are both of you on deed and title? Can you stay in the home? Can you stay in the home for as long as you'd like? So there's a lot of kind of information gathering at the beginning that we need to dig through and make sure that what you're wanting to do, not only can you qualify to do, but is it really within your best interest?
Right. And that's something, I mean, even having your name on the deed and the trust, sometimes you'll see that only one spouse has their name on there, which already makes things a little interesting going through that
Yes.
divorce process.
Yes. So that's the first question. And a lot of times, when we're writing a mortgage, we won't put both parties on the mortgage and the note, but they'll be on deed and title. So if one party can qualify on their own, maybe we don't put them both on the loan itself. So in that case, that gives us a different selection of options. But typically, people are going to need to refinance to get the other party off of the loan. And in order to refinance, you have to qualify as if you were purchasing the home. So all of the rules that applied to you buying the home are the same when you're refinancing. It's a full underwriting process. The other thing you can look at is a loan assumption. And some lenders have a provision for this, specifically in divorce. And especially since the last few years, we had such low interest rates. Sometimes you can assume the mortgage, which means that you get to take over that interest rate and the terms of that loan.
Without kind of doing the full refinancing option.
You don't have to get the new interest rate. You still have to go through the full underwriting process. So you still have to qualify. And one of the things that comes up sometimes with that option is that, the other party may want to have equity out of the house.
Right.
And if you're doing a loan assumption, you'll have to come up with another way to equalize assets or to give them the equity out of the house.
Interesting. Yeah, because I can see the other party, wanting either half of the house that they've already put in or some of those funds like that. So you would have to pay, your spouse out and kind of refinance the home.
Correct. So in that case, sometimes you can do a home equity line of credit to maybe make the other party whole. That may be a better option. One of the, everything's got a positive and a negative. So right now, with interest rates being significantly higher, most home equity lines are tied to the prime rate. So right now, at this moment in time, the prime rate is about 8.25%. Wow. And so it's something you really want to look at the whole picture and see, is assuming the other mortgage and taking out a home equity line, is that truly a better option? And what I like to do is I run several scenarios and I'll lay those out next to each other. So my goal is to help my clients make educated decisions. And then we can lay it out, and it's not an emotional conversation. I mean, it can be emotional, but we're saying, what are the numbers? What does it actually look like? And what can I do?
Right. That's so important because you want to see, you know, what all the different options are. Like you're saying, there's a lot of different ways and a lot of pros and cons. And so I know, you know, if let's say you're getting divorced, you might get some child support or some alimony. How does that kind of play into either helping you, you know, refinance the home or count as income if you purchase a new home?
That is a great question. So there's a number of rules when it comes to using support as income. So the first is the duration that we're going to receive it in the future. So how long after you close on the loan will you be receiving it? And generally we have to see that you're receiving it for 3 years after closing.
Okay.
The other piece is how long has it been received? So FHA and VA and conventional loans have different rules regarding that, but it's 3 months or 6 months that you've already received it. So we have to show proof that you've been getting it, that it's going to continue for 3 years, and we also have to show that the court has agreed and signed the divorce decree, the final decree, because that's what makes that support enforceable. So there's 3 really key pieces. One is continuance. How long are you going to receive it? How long have you received it? And that it is enforceable through the court system, so it has been signed off on by the judge.
So the signed off makes a lot of sense to me, but the 6 months that you might need the income before you qualify, that seems like a hard period to kind of balance once the documents are signed, if you want to stay in the home. It seems like a hard situation.
So sometimes it can be, but sometimes people will have been paying that while they're negotiating, they may have been paying that temporary support.
Oh, that's true.
So maybe before it was final, they've been paying temporary support. We can use that time frame of support that's been received, as long as it didn't go, it can go down, but it can't go up. So it's kind of an interesting caveat, but we can show that you've been receiving it while you're negotiating the divorce. However, it cannot be in the way of like, I paid daycare or I paid the car payment. It needs to actually be paid to that party directly.
That makes sense.
So that's important. That's an important part because yes, you may have been paying the support or receiving the support through a mortgage payment or a car payment, but we can't use that unless we're showing that the payment is actually made directly to that party.
Yeah, it needs to be like income almost versus just helping you pay some things.
Yes. Yes. And the other part of it too is that it's not taxable income. So for the purposes of our income calculations, we can actually increase the amount that they're receiving when we're doing the analysis of a party's income. So sometimes that may be just enough to stay in the home or to buy the new home that you wanted. And while that negotiation is happening, I like to have a conversation and say, here's what we need in order for you to qualify to stay in the house. And so when you're negotiating, you can go to your spouse and say, this is the support that I need in order to stay in the home. Or this is the support I can pay in order for me to go buy a new home. So it's a big puzzle to kind of put together to make sure that everybody's getting what they need from the end of it.
Yeah, there's a lot of moving parts.
Yes, very many.
Their question came in saying, does it count as directly if county is helping?
Yes.
Okay.
Yes. So if the county is, sometimes they'll get involved and they'll either take funds from a paycheck or something like that. We can absolutely use that. Yes.
Awesome. And so what if your kids are, 16 and 15, and you need that income for 3 more years? Well, that one is going to, be 18 and kind of age out. So you can't use any of that income to help refinance the house?
So the way that I would suggest structuring that agreement would be to say, actually specify after this child is 18 or graduates from school, this is what the new amount will be.
Mm.
So we can use that new amount, that one that will continue. So maybe we can't use the full amount that they're received because the 17-year-old will no longer be
Right.
supported for that much longer. But if we know that the 15-year-old in that example will be receiving a certain amount, then we can use the lower of the two.
Okay. So all these little details, it really shows how you need to be pulled into the conversation during these divorce proceedings, or some of the details, just so, things line up on the attorney's paperwork as well as yours.
Yes, that's really important. So a lot of times I'll be involved after, and
Hmm.
there are small tweaks that could have been made that allowed us to do what they intended, what the intended outcome was.
Yeah.
I recently had a family that had 5 kids. She hadn't worked. They were going to list the house immediately, or she had to refinance immediately. But she couldn't qualify for a new home yet, and she couldn't qualify to refinance because she hadn't received the support yet for long enough to qualify either way.
Hmm.
Um, so thankfully, the three of us were able to actually have a conversation, and they reworked the agreement slightly um, to allow her to have enough time. Because
Okay.
the husband really wanted her to stay in the home or have a
Right.
home for their children. His intention was not for, he wanted her to be able to buy a house. They just
Right.
didn't know. They didn't
Of
know that
course.
the rules were set up that way. So, in this case, it worked out. But, um, you know, some my thought is too, while you're doing the negotiating, maybe get a pre-approval already done,
Yeah.
so that when you're going to a mediation, you can actually say, I am able to do this, and know that you can.
Yeah, that's a great point. Just to know, yeah, that you can do what's in the paperwork. Because the attorney and the legal don't always line up with, the bank and the mortgage industry, when they're doing their paperwork in this divorce filing.
Well, and the other thing I like to also say is that the lending portion, we have on average 18 rule changes a day. So
What?
yeah, somebody told me the statistic years ago. Now, some of them are teeny tweaks that really don't impact, but what is true, maybe even when you bought your house a year ago, may not be the case today.
Yeah.
So it's important. Also, your credit is always changing.
Hmm.
I do see a lot of damage that is done in divorce with credit.
Yeah.
And again, a lot of that is maybe unintended, but I've had a client come to me and say, I had a year to refinance. I'm ready to do it. Well, her credit score had been so badly damaged that she was not able to. Whereas if we would have had that conversation, in that year, we could have spent some time working on how to improve her credit.
Right, right. That's why I also always like to bring up that, it's just great to have the conversation and just start dabbling, because even though you might buy a house a year out from now, there are some little steps that can really help improve that purchase when you get there. And so you don't
Yeah.
always have to talk to Jamie when it's like, I'm ready to buy the house right now. Let's call Jamie. It's like, no, you can call her a year in advance and she can help you kind of prepare for that.
Absolutely, because there's a number of benefits too. For example, a lot of people think they need 20% for a down payment.
Hmm.
You need 5%.
Yeah, it's
And if
huge.
you're a first-time home buyer, you need 3. And you're a first-time home buyer if you haven't owned a home for 3 years. So you
Mm,
get to be a first-time home buyer again. So maybe it's not as far out for you to purchase than maybe you think.
right, right. And so back to kind of when you talk with women, to stay in the house or not to stay in the house, besides the house itself, what are some other like considerations, women should take, besides just seeing if I can afford the mortgage every month?
So the way that we qualify you is you cannot have more than 50% of your gross monthly income going towards debt service.
Okay.
So as a broad strokes, it can vary slightly, but just say big picture. So if you make, let's say you make $1,000 a month, you can't have more than 500 going to car payments, student loans, your mortgage.
Right.
But that number is what you qualify for. That may not be the number that you're actually comfortable with.
Yeah.
So just because you can qualify, maybe you shouldn't. Maybe that mortgage payment, even though we will lend you the money, isn't a number that you feel good about.
Mm-hmm.
So, and then maybe you fight to keep the house, but in a year from now, you're going to sell it anyway because you're depleting savings or because it's just not comfortable with your lifestyle.
Yeah.
So I think that's a big piece is just because you can doesn't mean you should.
I mean, we always talk, a house is a huge upkeep. And sometimes when you have two people to kind of help manage that, but from AC units, filters, shoveling, lawn care, I mean, it adds up if you don't have,
Yeah.
kids to go mow it or something. If you just have, many little kids at home, it's a lot to manage as one person.
And rental is not the worst. I mean, obviously I'm a huge housing advocate, but if you're overstretching yourself every single month and it also is more stressful and it's more difficult, maybe we're just making a plan that says, okay, you're going to rent for a year.
Yeah.
We're going to set up, here's what your savings is going to look like. Get a sense, everything changes so quickly. Maybe in a year from now, you're going to be in a totally different place and you're ready to buy. But kind of part of that big picture, long-term planning is, homeownership, I think, is very important. It's very important to building wealth. But this may just be a moment in time where you can't cut the grass because you're going back to work and you just can't, to do the upkeep pieces.
I mean, we talk a lot about how so many things are seasonal in our life, and a home ownership can be really great to build wealth. But if it doesn't work in that season of life that you're in while you're doing everything else, you might just have to wait a year or two or three, and then once you get a better job or, kids are off to school or something like that, you have more time for those different opportunities. But it just kind of depends on that season you're in. You're already in a huge transition.
Right. And, maybe you want to go back to school. And so there's just not enough hours in a day to do everything that needs to be done.
Right, exactly. And so the last thing I wanted to touch on is, what if a family getting divorced has like a second home or a rental property? Is that kind of separated in the same way as the family home would be, or is there a different way to kind of go about that?
So that's a great question. This comes up actually quite a bit. So there's a couple of ways you can treat it. Sometimes it makes sense for one party for that to become their home.
Right.
I've also had where we had rental properties, and in lieu of paying more support, then the other party received the rental as part of their income stream.
Okay.
So sometimes that, again, we're laying it all out. I've also had clients where they owned multiple rental properties, and they decided that they wanted to form an LLC, and rather than refinance all those homes, they were already raising children together. Even though they're divorced, they're still forever mom and dad.
Right.
So they decided that they were going to keep the properties, put them all in an LLC, and basically share the income that came from those homes. Nice. So I don't think that's an answer for everyone, but for this particular couple, it works.
Yeah.
But it can be an asset that's sold and divided. It could be an income stream for one party. Especially with the advent of Airbnb, there's a lot of revenue that is generated from these short-term rentals.
Right.
But you have to be able to manage it. That's another layer. But yeah, it is treated much the same though as from a mortgage standpoint. You still have to be able to qualify for that. You can use the rental income as qualification.
Okay.
Qualifying income, as long as it's on your tax returns. So everything is about your tax returns. That's great if you're making cash and you're doing all that, but we can't count any of that if you're not reporting it.
It makes sense. It makes sense.
Yeah.
There's really no technical proof, so can't live on a promise.
Right. But there are other ways too. There are other types of loans, and we could get into this too, where you just use the actual rental income that property is generating,
Right.
Now, again, there's an offset there. Your interest rate is going to be higher, but you don't provide any of your personal documents. So you don't provide your personal tax returns. You don't provide any of that. But you can buy rental properties and investment properties just based on the property's ability to generate revenue.
Interesting.
Yes.
Yeah, that's a whole nother investment.
Oh yeah, we could talk about that another whole day.
Yeah, that's a whole nother investment video. But yeah, it's interesting to kind of talk about these different situations. And I just want to kind of highlight how that couple made an LLC and then I'm sure legally signed. So they both agreed to split these payments. Because I heard these lovely couples who want to do the trust factor of he said he would pay X amount every month to me, or, I got told the house is mine, but we never did it. We never did the paperwork.
Yes.
Because it seems like a lot of work. It's worth the work.
Absolutely. And particularly with the family that decided to manage those properties together, not only did they have everything drafted in their divorce agreement, they also met with an attorney who did business establishment, made sure that all of those documents, so everything was lined up and settled and discussed prior to, the water heater blowing up and who's paying for it. It was all laid out and all decided.
Yeah, it needs to be,
Yes.
It needs to be. That's always our piece of advice is just, if you agree to it verbally, please get it in writing as well.
Yes, and have someone else make sure that it's written to the legal code to make sure that it's, that it's enforceable too, in case you do have a breakdown. And we also put in that agreement, what was the plan if it didn't work.
Oh,
so if it didn't work, then here was the, so everybody had an out. If either party found that this wasn't a workable situation for them, then then here were the steps of what would happen next.
Yeah, I love that. And so if a couple is, even thinking about getting divorced or is going through the process, what's the best time to contact you on that timeline?
As early as possible.
Awesome.
It's always better. Because you may be fighting for something that when you find out what it really is, you don't even want it.
True.
So maybe you're really striving to keep the home or to have someone, but once you see what it actually looks like, maybe that doesn't fit what you actually, either your beliefs or your financial beliefs or what you really want.
Yeah, definitely. Great. I feel like we touched on a lot of great information. Is there anything that we missed that you want to make sure is shared today?
I would just say that if you are considering divorce, the marital home, there's real estate involved, I definitely recommend speaking to a lender that has experience in this.
Yep.
Because there are a lot of caveats and a lot of ways that we can really work through it. So, and you can find out, maybe you can do things you didn't even know you could do in a good way. Like we've said, maybe there's things you can't do, but maybe things are better, the outlook is better than you think. Or again, we can put in a plan to make sure that you're able to do the things that you wanted to do.
I love it. Yeah, it's all about having the conversation, making a plan, and then kind of taking action once you have all that information.
Yes, always. I'm a big fan of a plan.
We love a plan. So thank you, Jamie, for coming on today and sharing your expertise. If anyone has more questions or wants to reach out to Jamie, her email's been going through the bottom here. And she is also one of our Purse Strings approved professionals. So you could reach out to her off of pursestrings.co. And we'll be back with everyone again next week. So thank you again, Jamie. And I hope everyone has a great day.
Great. Thank you for having me.
Yeah. Talk to you later. Bye.
All right.